A huge real estate crisis is coming. Is it a good time to invest in real estate? Should you invest in real estate now? If you turn on the news on top of the pandemic, everyone is talking about the housing bubble. Experts warn that the real estate market will collapse in 2021. And as evidence, they bring the example of the 2008 crash that will follow in 2020. Exactly the same pattern, so the real estate market should collapse again next year. And that's pretty interesting because when we're in a bubble that's going to burst next year, it will be a once-in-a-lifetime opportunity for many people to get involved and make a fortune. Because a housing bubble means homes are being sold for a fraction of their real price as soon as the bubble burst. Imagine if a $200,000 home that you suddenly wanted to buy is up for sale for $70,000 or $80,000 and the interest rates are so low that once you can make the down payment, you can get them right away. Doesn't that sound like a golden opportunity? Everyone likes to invest in real estate because we think so. For some strange reason, property prices will always go up, but we've seen it do so countless times, and house prices can go down. In order to know whether or not investing in real estate now is a good idea, we need to understand a few things. Are property prices always rising? How was the real estate bubble zone created? And when exactly will the market collapse? Before you go any further, I would like to take a moment and thank our sponsors, Skillshare. If you want to learn how to analyze and find out if companies like professional investors, a particular company is a good investment or not, you must take this Skillshare course as it is taught by a professional investors used to value a company. And it's taught by Business Casual, the YouTube channel you probably know. I took the course. It's short, lively, and well worth it. Skillshare is an online creative learning community that draws millions take the next step on your creative journey. Skillshare offers thousands of inspiring courses for creative and curious people on topics including illustration, design, photography, video, freelance work, and more. And all for less than $1 a month with an annual subscription. But since you're the best audience on YouTube, the first 1,000 people who click the link in my description will receive a free Skillshare trial. Cousin. By the way, it will support the channel by unsubscribing from Skillshare. And now we come back to the video. Autumn 2008, the mother of the real estate bubble's one of the tools the Fed has to control the economy is the interest rate. When the economy grows too fast, the government steps in and raises interest rates to stop the flow of capital to the market so that the economy does not become a bubble, because high interest rates mean borrowing money becomes expensive, which means fewer people they would borrow money, which would result in less cost. And vice versa. This is known as monetary policy. In the 2000s, when the dot-com bubble burst, the stock market lost nearly $5 trillion. Market cap dollar, the economy was in recession, so the Fed cut interest rates, from about 3% to 2.5% and then 2% to just over 1%, encourage everyone to borrow and spend money to get the economy going again his knees. And it worked, until 2003 the economy began to recover. By 2006 the stock market reached its level.com drop level. However, low interest rates mean low yield on government bonds and interest from fixed deposits. It no longer made sense for investors to buy government bonds or keep their stacks of cash in banks, as inflation would slowly use them up. Especially a few years ago they generated incredulous returns during the dot-com bubble, the S&P 500 soaring more than 400% from 1995 to 2000. Hence, investors were looking for a new way, a safe and growing investment to bring their products to market. Money and real estate seemed like a great idea, but the investor doesn't have time for it dealing with individual buyers, so that financial institutions came up with a brilliant idea. Since interest rates were so low, everyone bought a house, so financial institutions would take out these mortgages, pool them, and sell them to investors in the form of stocks. These investments turned out to be very good, but the banks ran out of funds. People borrowed mortgages, but investors still wanted to buy those investments. So the banks started giving subprime mortgages or mortgages to people with really low credit score. People didn't necessarily have enough income to keep making mortgage payments. Why? Because they would take out these mortgages, pool them, and sell them to investors. Low interest rates and rising property prices continued to attract more investors. The reason these investments look so tempting is that investors argued even if they default on their loan, it is not a big deal that the bank can return the house and sell it. As house prices rose, they would still do it a win. It seemed like the perfect investment. So the banks gave everyone mortgages, which drove house prices to incredible highs. But at some point, one of the borrowers defaulted. Then his house was put up for sale, then the second, then the third. Soon there were so many houses for sale but not enough buyers, and house prices began to fall. When people say that their $500,000 mortgage home was suddenly worth $250,000, they stopped. It made sense to keep making mortgage payments, so they walked away from them. Now there were more houses for sale, which lowered property prices even further. This left the banks with a lot of worthless mortgages that no one wanted to buy broke one by one. But how does it all relate to the 2021 crisis? Well, the government stepped in and saved the big banks in exchange for getting tougher their rules and do not grant random mortgages unless they have a sufficiently high credit score points and be able to make monthly payments. For some time, if you tried to get a mortgage in 2010, the banks would charge you have endless documents showing that you are financially responsible and want a stable workplace that enables you to make your mortgage payments on time. As a result, property prices returned to pre-crisis levels in 2012. The only reason the market would collapse again is if house prices rise dramatically again and there will be no demand to satisfy it. Over the past 8 years, house prices have increased but mortgages have stopped being granted irresponsible borrowers. In fact, the Fed stepped in 2016 and raised interest rates from 0.25 to 0.5, so there won't be a bubble. For 2019, the interest rates were 2.5%. Borrowing funds became expensive, although the number of mortgages was reduced to a certain extent, but the demand was still there, so prices continued to rise. COVID-19, the crises that imply the collapse of the real estate market. When the pandemic halted the economy, it became clear that this was the real estate market collapse because millions of people lost their jobs overnight, which means no be able to continue to make your mortgage payments and stop paying your mortgage. That means that suddenly too many houses will be on the market as it was in 2008. House prices will fall, which means the real estate market will collapse. What we're not taking into account, however, is that the Fed recently launched a home crash, so he knew how to stop it. First, the government was handing out stimulus checks to help everyone pay the bills. The government gave financial support to companies that keep their employees. Most people you could still pay the bills, including the mortgage. And to seal the case, the government put in place a tolerance plan, which basically means, you can suspend your mortgage payments until 2021. And that means no one will be in default this year or next year. Hopefully, a vaccine will be available and everyone can go back to work and move on your monthly mortgage payments. But why are house prices continuing to rise amid a pandemic? Recall that at the beginning of the video we talked about how the Fed is cutting interest rates during recessions to stimulate growth. That's exactly what they did. The Fed cut rates to 0.25%, which made borrowing more affordable. The demand for houses increased, but the supply did not. Is the market overvalued? Probably. But it's definitely not a bubble. Once the 2020 roller coaster is over and life is back to normal, property prices may come down what they're really worth, but that might not happen next year. If you take individual cities like San Francisco, New York, or Los Angeles, the real estate prices naturally apply could be a little overrated. But that's just it. So is it a good idea to invest in real estate now? Probably not, as the market is slightly overvalued and there could be a correction next year. On the flip side, timing the market is also not a good idea, especially in residential construction. The market as house prices don't rise and fall like stocks, so you may have to wait a few more years. And now it's your turn. Do you think we're in a bubble? Will house prices fall next year? Let me know in the comments below. And that's all for today. Make sure to approve this video if you liked it. And if you're new here, hit the subscription button and the bell next to it. Thank you for seeing us and see you next time.